In modern times, it's hard to imagine a time when banks didn't exist. Yet, the story of banks is a captivating tale that stretches back through centuries of human civilization. Have you ever wondered how this banking system came into existence? Today, we will share with you the history of the bank. Here we go! First, let us take you back when the idea of money was not invented. In ancient times, people didn't have money. They lived in small communities and made everything they needed themselves. But as villages grew and people developed different skills, they realized they could trade their extra things with others. This trading was called barter. For example, imagine a farmer who had lots of wheat but needed tools. They would find a blacksmith who wanted wheat and exchange it for tools. Thus, people exchanged things in between, and believe it or not, this was the first step of modern banking. Now, let us take a look at the birth of banking. The barter system worked pretty well for small communities, but as soon as people started venturing out and exploring new towns, things got a bit tricky. They wanted to find new markets for their goods and discover cool products to bring back home. Before we start about the birth of banking, let us remind you to hit that subscribe button and turn on notifications so you never miss a video from us. As we mentioned, bartering had some problems though. It was hard to find someone who wanted exactly what you had to offer. To solve this, people started using special things like shells or metals as a kind of money. These items were valuable and could be traded for other things. This made trading easier. Later on, people made tokens or certificates to represent the value of what they owed or were owed. Finally, people began minting coins of different sizes and metals. These shiny little things became a convenient way to store value for trade. But hey, coins needed a safe spot, and ancient homes didn't have those fancy steel safes we have now. So the wealthy folks in Rome had a clever idea. They stashed their coins and jewels in the basements of temples. They thought those temples were super secure because they had priests, temple workers, and even armed guards keeping an eye on things. Historical records from ancient civilizations like Greece, Rome, Egypt, and Babylon suggest that temples didn't just keep money safe, they also loaned it out. They were like these financial centers of their cities, offering loans to people in need. It's no wonder that during wars, these temples often got ransacked. They were like treasure troves waiting to be plundered. Now, coins were way more convenient to exchange and hoard compared to other stuff like massive 300-pound pigs. So this group of wealthy merchants saw an opportunity. They started to lend out coins to folks who needed them, and to get this, they charged interest. Talk about making a profit. Temples usually handled the big loans, even lending to kings and queens, while these merchant moneylenders took care of the rest. Banking in the Roman Empire. The Romans started to move banking out of the churches and into separate buildings. During this time, moneylenders and loan sharks still made money, but most legal business and almost all government spending went through a bank. The World History Encyclopedia says that Julius Caesar was the first person to let bankers seize land instead of loan payments. This was a huge change in the power balance between creditors and debtors. Before this, landed noblemen couldn't be touched, and their debts were passed down to their children until either the creditors or the debtors' bloodline died out. In the Middle Ages, Pope bankers and the Knights Templar kept some of the Roman Empire's banking institutions going. Small-time lenders who tried to compete with the church were often called out for charging too much interest. The rise of free money banking, inspired by Adam Smith. When economist Adam Smith introduced his concept of the invisible hand, banking was already well established in the British Empire. Smith's ideas about a self-regulating economy allowed moneylenders and bankers to keep the government at bay and maintain control over the banking sector. As the United States of America emerged, the principles of free market capitalism and competitive banking found a fertile ground. However, the early days of banking in the U.S. were marked by multiple currencies, risks of bank failures, and a lack of cash. Alexander Hamilton, the first Secretary of the U.S. Treasury, established a national bank to stabilize the system and create a uniform national currency. Despite some challenges and public distrust of banks, the national bank played a significant role in shaping the U.S. banking system. Eventually, the national banks consolidated their power by taxing state banks and solidifying their position. However, this led to a general fear of banks among the population, and Texas even passed a law prohibiting private banks until 1904. The ascendancy of merchant banks. Large merchant banks like Goldman Sachs, Kuhn, Loeb and Company, and J.P. Morgan and Company gained a lot of power and impact in the years before the 1920s. These banks took advantage of their international links and did a variety of business activities such as loans, corporate finance, and taking care of commissions from the sale of foreign bonds. As industrialization progressed, major industries required substantial amounts of capital for expansion. The merchant banks recognized the need for extensive financing and turned to public offerings such as IPOs and bond offerings to raise the necessary funds. Successful offerings not only bolstered a bank's reputation, but also provided leverage to secure underwriting roles for future offerings. By the late 1800s, banks started demanding representation on the boards of companies seeking capital. In cases where the management of these companies was deemed inadequate, the banks took control and assumed the role of running the companies themselves. This further solidified the merchant bank's influence and control over various industries. J.P. Morgan rescues the banking industry. J.P. Morgan and Company emerged as a leading merchant bank in the late 1800s with strong ties to London and significant political influence in the United States. They created major corporations and dominated industries using trusts despite disregarding antitrust laws. Average Americans had difficulty obtaining banking services and loans as merchant banks focused on the wealthy and racial discrimination was prevalent. In 1907, during the bank panic, J.P. Morgan personally intervened to halt the crisis, showcasing his power and ability to stabilize the financial system. The birth of the Federal Reserve, the end of an era. The establishment of the Federal Reserve Bank, the Fed, in 1913 marked the end of private bankers, like J.P. Morgan, wielding immense power. While the merchant banks influenced the structure of the Fed, its creation pushed them into the background. However, financial and political power remained concentrated on Wall Street, with the United States becoming a global lender during World War I. To address concerns and stabilize the banking sector, the government imposed conditions on war loans repayment, causing trade slowdown and strained international relations. The stock market crash in 1929, known as Black Tuesday, further devastated the already sluggish global economy. Despite the effort of the Fed, thousands of banks failed between 1929 and 1933. To restore confidence and salvage the banking sector, new laws were enacted. The Glass-Steagall Act of 1933 prohibited commercial banks from speculating with consumer deposits, and the Federal Deposit Insurance Corporation, FDIC, was established to insure accounts up to certain limits. As of 2023, the insured limit stands at $250,000 per account. These measures aim to restore stability and protect consumers' deposits. The rise of modern banking in the shadow world of World War II. World War II may have kept banks from going out of business completely. For the banks and the Fed, the war needed billions of dollars worth of financial moves. Because of this big financing operation, companies had a lot of credit needs, which led banks to merge to meet the demand. These big banks worked in markets all over the world. More importantly, banking in the United States finally got to a point where the normal person could trust the banking system and get credit easily. This was made possible by deposit insurance and widespread mortgage lending. It was the start of the modern age, the digital revolution in banking. The most important change in banking in the late 20th century and early 21st century was the rise of online banking. Online banking has been around since the 1980s, but it really took off when the internet became popular in the mid-1990s. The trend moved even faster as more and more people started using smartphones and mobile banking apps. Even though many customers still do at least some of their business at brick-and-mortar banks, J.D. Power in a recent study found that 41% of them have switched to digital-only banking. There we have it, the history of banks. So, how do you think our banking system will evolve in the future? Let us know in the comment box. Thank you for joining us, and we look forward to bringing you more historical videos in the future.